Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone. Welcome to the Millionaire Next Door podcast. We're so pleased you're here with us. Today, we have another really interesting episode, and we've covered a lot of issues, a lot of financial planning, estate planning. We always like to come back to markets, what drives that. And we have a definite regular, longtime listeners of the podcast are probably familiar with my current guest, Miles Clark. He's a senior analyst with Nasdaq Dorsey Wright, provides terrific perspective of what's going on in the markets. And I should let everyone know today, as we're recording this, it's May 29, 2026. I always let people know that on a little bit more market-oriented podcast, just so they have a time reference and in case things change. But Miles Clark, welcome. How are you?
Hey, Robert. Nice to meet you. Or not meet you. What are we doing? Good to see you again. Yeah, this is what the third or fourth edition that I've been on here, and always a great time. And I like the way you say we'll post-market there for if things change. I think probably a better way to put that is when things change, inevitably, right? We are sitting here on, like you mentioned, at the end of May. Just yesterday, they had mentioned possibilities about a 60-day continuation of the ceasefire over in Iran, over in the Middle East. But of course, President Trump hasn't agreed to it yet, right? So there's a big old asterisk. But we'll talk about all of that and everything today. But to keep the intro light, things will change. But I'm certainly excited to be on and talk about everything that markets are throwing our way.
Yeah, no, it's great to have you here. There's always so much insight. And we're really at a very interesting time, right? With AI, with technology, we're going to delve into semiconductors and energy and all this stuff. Do you want to give a little bit of overview, maybe talk about some of the asset class leadership or what you're seeing from your view and your perspective and what's going on there?
Sure. Yeah. Why don't I first, although like you mentioned, the longtime listeners probably heard me a few times on what Dorsey Wright is, but just in case there's anyone new listening, I'll give a quick spiel about Dorsey Wright and kind of the way that we look at markets. So in layman's terms, Dorsey Wright is essentially just a way to utilize relative strength, to harness relative strength and select assets that are moving higher and avoiding assets that are moving lower or exhibit relative weakness. So all that to say, we utilize price and price action alone to help dictate which assets are strong and which assets are weak. And that spans across the globe. So it's not just on the domestic equity front, which is what people think about, right? It's within fixed income, it's in internationals, commodities. So we can use this kind of relative strength ideology across assets and make sure that we're in those strong ones rather than the ones that are relatively weak. But with that said, what we're seeing as we move into June is really continued strength from the equity space, right? Risk on assets doing particularly well. When you look at our overall rankings, domestic equities, international equities, commodities have slipped a little bit as precious metals have struggled, but their leadership has been overtaken by crude oil, which has really rallied up to the top of the rankings there. But again, when you kind of see those three asset classes, international equities, domestic equities, and commodities at the top, you really know that you're in a risk on posture over other groups like cash, fixed income, or currencies and things like that. Is that a good kind of general overview before we dive into anything else? Or
Yeah, it's a really good overview. We see it and I think people feel it. I'm an advisor, so I'm tasked with actually allocating or deploying the assets or all these questions. Are we at the top or where are we at? So it continues to move up. I see it is a risk-taking environment. People have been rewarded for taking that risk and they're leaning into that risk. Other people are sort of risk averse and wondering if this is the right time. Your style, you say it is what is. So we just want to identify what the environment is. But yeah, that's super helpful. So let's keep going. Yeah.
Yeah, it was funny. I was doing a little bit of homework before this one, and I was like, okay, what did we talk about the last time? And the last podcast was mid-March, and that was when the conflict over in the Middle East had really gotten started. And we were talking about domestic equities are still strong, but we're starting to see leadership rotate towards more value oriented areas, and markets just had to go and make a fool out of us there. We were
Right.
talking about that. The S&P since then is up 13%. The Nasdaq composite is up 20%. So obviously it's been a resurgence of strength from those growth focused areas. Your A obviously is a massive driver of that, semiconductors specifically. But again, your growth focused areas are really doing a lot of the heavy lifting, which is leading to a really productive market environment, again, for those risk takers that are out there that are going out and picking up either focused exposure into high RS names, or again, if you're just really focused on the likes of the NASDAQ 100 and some of the tech exposure there. But again, I thought it was very interesting. Just a few months ago, we were sitting here saying, maybe watch out for a rotation away from growth. And now we're sitting here 3 months later saying, yeah, I don't think so.
Yeah, and it's an interesting environment. It's piling on growth so heavy, the semiconductors. And another thing I've seen where the software space got hit so hard, it's all of a sudden sort of roaring back when cybersecurity. I guess you could expect energy and with oil prices high to be a strong area, but that's just been interesting too. So it is interesting how it rotates back. And the semiconductor space really has been unbelievable. And sometimes these things are hard to justify from either a PE or a concentration standpoint, yet they continue on and they can continue getting stronger and stronger. But
there is so much to unpack there. It's not even funny. I'll start off with some high level interesting statistics, and these aren't technical focus, so they're not kind of Dorsey specific here, but I saw some interesting stats. It was like semiconductors now represent something like 55% of the broader technology space, and they also represent something like 22% of the broader S&P 500 after this big rally. It has been absolutely insane, obviously, the growth that we've seen. And I almost want to say almost euphoric, if you will. We were talking around the office and saying this feels, if you're just using your gut, what we've seen here feels a bit much. That's what assets will do, right? They will run in your face, and that's what relative strength really aims to pick up on. Is it will say, oh, semiconductors are overbought right now. That's just because they're a relatively strong asset. Our senior portfolio manager, who's out in your neck of the woods, John Lewis over in Pasadena, he says this at every one of our conferences, and he's, for an asset to be up 500%, it also had to be up 100%. And 200% and 300%. And all the while, you would have said that you were at a top. So, with these assets, semiconductors are just another example of them. When they go on these right tail events, these massive winning streaks, it certainly feels intense, but ultimately, that's just price telling you that you're in a relatively strong environment.
Yeah, 100%. I think one statistic that really, really caught my attention and drove it home. It might have come from your guys' work or material with things you'd published, but you guys were saying if semiconductors were their own broad sector, it would be larger than every other sector except for technology, and semiconductors make up more of the S&P 500 than the energy sector, consumer staples, utilities, real estate, basic materials, and communications combined.
Yeah, you just say that sentence again and don't have yourself a little laugh. It's obviously just been intense, but another piece, right? The driver of that has been Micron.
Yeah.
And this was quite interesting. I actually put together a research piece on this. Obviously, at the time of this recording, they've just hit about 1 trillion in market capitalization, which on its own is certainly a feat. It joins maybe 10 to 15 companies that are at that point. But I then asked myself the question, how quickly did each one of those stocks, right? Think about your NVIDIAs, your Apples, your Teslas, your Berkshires, those guys, how quickly did they move from 500 billion to 1 trillion, right? How many days did it take them? Do you want to take a guess at how long it took Micron to get from 500 billion to 1 trillion?
I think I know the answer, so I don't want to give it away, but the others labored for a really long time. But didn't this happen in something like 6 months or 42 days or something shocking like that?
It was 48 trading days. And for reference, the next fastest was Tesla that got there in about 180 trading days. So the point is that this is extremely high growth. But again, it feels intense, and it certainly is intense. But what momentum teaches us is it's important to take that ride as long as you can. Yeah. And then ultimately, price will tell you when a new leader is in town, right? And that's the best thing about momentum, is that it will correct itself when it's ultimately wrong, if it's ultimately wrong. And it'll say, okay, I think Micron's done, or I think semiconductors are done. Now let's go into something else like energy or industrials or whatever it may be, right? But that's the bread and butter of your momentum or your relative strength strategies, is sticking on to these right tail events longer than other factors will.
Yeah, giant. And I explain to folks too, stuff I've learned from some of the work you guys have done, just how in a portfolio, if you have 100 holdings or 50 holdings or whatever you have, that N is, a lot of them just trade a little bit up, down, but you could have just a few that are absolutely giant, what you call kind of these right tail winners, might just be one or two that could drive so much of that outperformance, right? You don't need them all to work. And on the left tail, things that are not working, if you can trim those out fairly quickly or recognize that they're not in favor and just keep those out, it just drives massive outperformance. But it can come from just a very few participants, right? That's been
Yeah,
part of
and,
what I
and that's
understood.
the whole return profile. And that actually leads, it's almost like you're reading from a script. It leads us right very
I'm
nicely
not.
into one of our next talking points, which is some common questions that people might have about momentum. And one of those, there's three of them. We might have time to get to all three, but probably the most important is this idea that trend following or relative strength or momentum, whatever you want to call it, it inefficiently chases winners, right? To put it simply, it buys high, sells low. And really what happens is momentum aims to buy high. It doesn't always work, right? But momentum aims to buy high, sell higher. And to kind of quantify this, I had done a study, this might have been a month ago or so at this point, that took a look at one of our models. And all this model does is it buys high relative strength names within the S&P 500, right? And it owns, what, 20 of them. The specifics aren't important. What is important is the trade distribution of what those returns looked like. One trade plus 10%, one trade minus 20%, so on and so forth, right? What's important here is the difference between your average trade and your median trade. So average obviously influenced by your big events, like heavily, right? While your median is maybe a true indicator of the middle. And stop me if I'm getting too deep here, but the median trade is actually negative. So what that means in plain English is most trades, your normal trade is actually a loser, but your average trade, the one that's influenced by your right tails, that is around 23% in this model. Again, it doesn't matter that's what the model is. What matters is the difference. All of momentum's kind of return profiles look like this, where you have a big average return that's influenced by your right tail events, and you've got a bunch of little losers. And momentum does a really good job of cutting those losers short to try to find more stuff in the right tail. I hope I didn't lose everybody there. Robert, maybe
Yeah.
did that make sense? Maybe.
No, it does make sense. Hey, let me take a little step. It's not a step back, but I think a key question for a lot of folks, okay, given where we're at, if we're in very overbought markets or sectors like semiconductor, what does history suggest, or what is the thinking around allocating or buying it at all-time highs? What do you guys have any thoughts on that, or how that's worked,
Yeah,
in the
we've
past?
we've done a lot of studies, and I don't have any specific statistics right here in front of me, but more often than not, in order to get to all-time highs, you have to be in a strong market environment, right? You are not at all-time highs when the economy is in shambles, right? Putting money to work more often than not, even at all-time highs, is typically the kind of way to go. Obviously, there's some comments whether you want to say we're very overbought, so maybe we want a dollar cost average in here, or maybe we want to wait a little bit. But more often than not, if you wait a little bit, the market goes up another 5%, and then you're sitting on your hands there at that point and saying, I can't buy it now. So more often than not, it's this saying time in the market rather than timing the market is the kind of adage around the office. And so it's that, right? Hey, we're at all-time highs. More often than not, just put the money to work, look away, and just got to relax as best you can.
It can be hard to do or counterintuitive, but you guys are looking back across data, and I get it. And a lot of folks are obsessed with trying to time it just right. We're not timers. You're not timers either, right? So
No.
that's almost impossible. And anybody who thinks it is, they've figured it out better than I have. That's for sure. But
You got
we
to get
try
them
and
on the
take
podcast. That's your next guest.
that's the next count of time at yeah. I just think it's a fallacy. But we're just looking at the overall. Yeah, that's where we've been at for a while. And then against this backdrop of this war, blocking the Strait of Hormuz, I think it's just so important to look at what is and what's happening. Or give me some other thoughts of that or things you guys are seeing that might be worth covering.
Yeah, we might have talked about this last time, but if not, that's completely fine. We had talked about this idea of historical asset class performance around wartime, right? So we
Yeah.
look at other historical instances, and there's a nice table, which obviously the listeners can't see, but on average, markets are actually positive, and by a decent click rate after the war. At 365 days out, markets are positive by about 7.5%, 63% of the time. So a little bit over half, maybe 2/3 of the time after historical initiation of conflict going back to 1941 and World War II. So point is, obviously, no one likes war. Certainly don't want to be misconstrued there. No one likes war, but markets don't seem to mind it, I think is the point that I'm trying to make. And now that we sit a few months out from the initiation of the conflict in the Middle East, obviously we've seen a lot of headlines, a lot of we've seen some increased volatility, but more often than not, or what we're seeing here is just a continuation of historical averages, right? Markets are positive, and yeah, and other asset classes are too. Crude oil obviously is positive with that unrest. Internationally, international equities continue to do quite well. Commodities have also perked up. So point is that what we've seen after or over the last couple of months has fallen in line with historical averages, I think is the point that I'm trying to make.
So interesting. Yeah, the energy sector interests me a lot too, because obviously there's just so much. I know this is beyond your scope and the momentum. So maybe you could comment on momentum there, but you have a lot of factors going on, right? Oil at these prices, a lot of the world shut down, the supply. You've got, was it UAE who left the OPEC?
Yes,
I mean,
OPEC plus.
yeah, that's pretty giant development, right? And a lot of this infrastructure over there has been bombed out and whatnot. So I'm not sure we're done. And then you look at these other sectors, the semiconductor getting so huge, some of these spaces, some of these that are broad sectors, but might not be as much market capitalization. If money starts flowing in or out of there, it can be really giant just since they're smaller sectors. So just curious if anything that stood out in the energy space or any other spaces that you think really, deserve attention or are very notable.
Yeah, energy moves around from a sector perspective. Energy is one of the more volatile sectors. It will go sit down at the bottom of the rankings for quite a while. Then you'll have some type of supply shock for whatever reason, and then it'll jump its way up to the top. Energy right now sits towards the top of our rankings from a sector perspective, along with technology. Energy is in second or third. And then the other one that's up there has been industrials. Industrials, they're probably the other sector that I'll give a quick shout out to. Industrials at the beginning of the year were lifted higher by the likes of aerospace and defense companies, right? This started with the Venezuela conflict. Obviously, that spilled over into the Middle East. The point is that started earlier in 2026 with aerospace and defense companies, which still look relatively attractive, but that has also done or had some crossover into construction areas, right? Because who's building the data centers, who's building the infrastructure to make sure that we can have our AI and everything like that. We've seen really nice tailwinds for that group as well. And I do think that there's some interest, maybe not for the scope of this podcast, but I'm interested in AI. Everything is virtual, obviously. But at the end of the day, something tangible has to hit the ground, right? There's transports. Transports look good, right? You're transporting stuff around, you're building stuff. So it all goes back at the end of the day to a hammer and a nail, building something here in real life, not the metaverse.
Yeah, no, we're at an interesting point in history, right? With so much going into AI and the infrastructure and the data. And it does make me think back a little bit when they were building out the internet, right? Remember Global Crossing? If you remember this, they were putting undersea cables and stuff like that to across the globe. And I think these companies actually ended up going away, went bankrupt. They built this stuff out. And so now we have this connected internet. You remember back, I don't know if you remember back, but the AOL online and dial up and all that kind of stuff. Thank goodness they did that way back when. But we're building it out. It's just interesting. And you mentioned transports. I actually went on get invited onto a private tour. last week of the port of Long Beach and Los Angeles. It's the largest port on the West Coast of the United States, maybe the largest port in the U.S.
Wow.
And we got to, it was actually really cool. So there's so much, everything from Asia moves through there. That's where they want to go through. And most of this is all private and how it's done. But just watching this loading and these containers going on and off. And one of the docks they showed us, we took a boat right up to it. They said this is the world's most sophisticated one. It's pretty much all AI or automated driven. And it used to take the other terminals, they're all manned. And they have dock workers who they call them stevedores. That term kept coming up and up. So I never had that in my vocabulary till now. But they're moving most of the goods into the West Coast. And it's just so interesting. So this one is totally AI driven. The others, apparently the union that does that, they agreed to it, but I don't think they'll ever do it again because the other ones are manned by people who are skilled, but they're apparently paid there's a sort of a two-man shift. It's an 8-hour shift, but really they're only working about 4 hours each, and they're paid $400,000 a year. So it's a pretty high-paying gig, and there's a lot of responsibility, but you just see all this and just all the intricacies and the dynamics of it. We had someone there from Ports America. They're a private firm. They manage 40 ports in the United States, so they know every port. But it was so interesting, and a lot of stuff comes out of trucks, more stuff out of trucks than rail. I think it's something like 60-40. But interestingly, the rail, at least in Los Angeles, they built it out where they can double stack it. And across a lot of the infrastructure in the U.S. in these ports, there's a lot of bridges where you couldn't double stack it, right? As the second container would hit. So just watching, when I drove out of there, there's all these trucks up and down the freeway there. I'll never look at a truck the same way again. So I guess I'm going down a deep rabbit hole, but this is everything that goes to Target, to Costco, to Walmart. It's going through there. And it was just so interesting to see. And there's pretty inelastic demand. And anytime things go up like fuel prices or labor or anything, it's all passed along. Right. So it's all baked into the supply chain. But things look pretty healthy there.
It's a big world out there, right? Like there's a lot of stuff going on, and obviously a lot of stuff going on in markets. I do want to go back to one conversation we were having about, it all leads back to semiconductors, of course, but what leads to a productive momentum environment? Because momentum is doing quite well, right? Yeah. Finding the winners is doing quite well in today's market environment. And the reason for that is when there is a big difference between your winners and your losers. So as you mentioned, Robert, earlier, software has turned it around a little bit, right? But earlier in the year, software was doing poorly, very poorly. It was semiconductors are up 5%, software is down 5% in a day, right? So it was a big dispersion between your winners and your losers. Those types of environments are very productive for momentum strategies. And the reason for that is that your momentum strategy can focus on those few stocks or assets that are doing very well, and it can completely avoid those assets that are doing very poorly, right? So just in the technology sector, for instance, again, you're focusing on semiconductors and avoiding software. And so your benchmark can't do that, right? It's stuck owning all of your software that momentum can essentially tactically rotate away from. So when there is a big dispersion between winners and losers, that ultimately ends up being a quite productive environment for momentum. And we're seeing that across the globe, right? That's not just here in the United States. We're also seeing that internationally. Small caps is a little bit more rocky. We won't talk about that. But again, with your kind of larger names, you're seeing a very fruitful environment for trend followers so far, at least, knock on wood.
Yeah, that's great. I follow the momentum quite a bit. It's certainly I'm observing what's happening, whether it's working or what's strong and what isn't. It's a fairly integral part of my consistent process. I call it our process. We're objective, unemotional, rules-based. It's just an interesting framework and process to have because I just see a lot of folks who had a hard time processing, hey, we have this war in Iran, the news headlines, why would I want to go into this market? Everything's going to fall apart. It hasn't. It's consistently moved up and to the right. And then from another lens, like software being so crushed earlier this year, or was this year or late last year? I don't know. But on this, this prevailing thought that AI would completely replace its business model, the jury's not out on that yet, but it seemed a bit overdone, yet you see it coming back. or a cybersecurity. I just thought that was an ongoing issue that will continue to grow, yet that software got dragged down quite a bit with the software space, but it's coming back in such a strong way. So it's always interesting to see where capital flows and what kind of large decisions are made for allocations. And your system and your tracking does a really good job of processing that. And it's just always interesting. You don't always know why initially, but usually over time, it ends up sort of making sense and you can see why, but you don't always have to know why initially. You just have to be aware that lots of stuff's flowing this way. There's got to be some reason we want to be aware something's going on, right? Or
And you want to be a part of it.
you want to be a part of it, yeah. Or something else is really going south, right? I-5 south as opposed to I-5 north here. And maybe we don't fully understand it, but we want to be aware of it, right? And cautious around that space until maybe that trend changes. And a lot of times those trends don't change for a really long time, if ever, right? The changes are very integral, I would assume, is how you'd view it.
Certainly. Yeah. And I want to go back to one thing that you mentioned, which is we want to be aware of these changes and we also want to follow them in an unemotional way, right?
Yeah.
Emotions are everywhere, headlines are everywhere, right? We can all turn on the news and get 20 bad sound bites in 20 seconds, right? And you will always have a reason to not put money to work, not be a part of what's going on now, a 3 to 4 year bull market coming out of 2022. Having a way to not only identify which way markets are moving, but then two, put money to work without your emotions misguiding you, right? Because emotions are great, right? We all love laughing, we all love having fun, and we all, whatever it is, but you can also look at markets and get scared, right? And so there's this element of we want to take the emotion out of participating in markets because ultimately emotions can sometimes lead us down the wrong path and selling something that we shouldn't have or buying something that we shouldn't have. And so that's the main goal, is looking at markets through a lens that kind of takes the gut out of it, if that makes sense.
Makes a ton of sense. And that's a process we deploy a lot. And I sit with clients all the time, so I hear this stuff. Oddly enough, I don't follow that much news. I literally had during a physical exam I had with my doctor a couple of years back, he was going through these questions regarding high-risk activity. Do you drink? Do you smoke? Do you text and drive? And within this string of a whole lot is, do you watch much news? I said, not really. But it was just like, this is a major component of whatever, your health or your blood pressure, you may not be thinking about it. And so I had figured that out, but just to have them put it in that context. So I'd rather watch what's actually occurring versus the news of the sound bites or all the stuff they need to keep you interested until the next pharmaceutical ad comes on. But This has been an amazing discussion. Is anything else really big? I love having you on the podcast for the commentary, for the observations. We're kind of really kindred spirits here and looking at the same things. But anything else standing out or any other thoughts you have that we should maybe cover?
I will do a very quick, because I know we're coming up on time, I'll do a very quick spiel about participation, because I do think it's interesting. When I say the word participation, what I essentially mean is what part or what portion, how much of a universe is moving up or moving down, right? So if participation is good, that means a lot of stocks are lifting markets higher. If participation is bad, that means that only a select few stocks are moving markets higher. What we've seen, we started 2026 with participation towards the top, right? A lot of stocks are doing quite well coming out of 2025. And then ultimately what we've seen, participation starting to wane a little bit, right? And, what it's getting more, or what it's starting to look a little bit more, is a 2023 type of market environment where you are still in a productive, markets are still moving higher, but it's at the hands of fewer and fewer names, right? It's at the hands of the Microns, of the NVIDIAs, of the Googles, rather than all of the stocks moving up at the same time. So I think if we prepare for our next podcast in a few months, I want to revisit that and kind of what ended up happening. Because again, we've seen markets move higher, which is ultimately a good thing. It's getting a little bit more rocky in terms of at who's actually driving the ship. Is it everybody, or is it just one or two guys? I think that's an interesting point to kind of wrap up on.
That's a great point. It's waxed and waned a bit, but yeah, it's become very narrow, right? And that's something to certainly pay attention to, how sustainable that is, or maybe it'll just continue for a long time. But generally speaking, don't you view broader as a lot more healthy under the surface, or do you not make assessment calls like that?
No, we'll say the adage, right? It's the generals versus the soldiers, right? The generals are your big stocks. They're your Mag 7, right? They're your Microns now at this point. A general is the smartest guy on the battlefield, but he's nothing without the army behind him, right? And so we need to have the army behind us, the other 493 of the S&P 500, for example, to be lifting us higher. But like you mentioned, Robert, the generals can be out there fighting for a long while before they ultimately fall. And they've shown us that throughout 2023, 2024. Those were market environments driven by just a few names, and it lasted a lot longer than we would have thought. So all that to say, participation has waned. It's gotten a little bit more narrow. That isn't necessarily a bad thing, but I probably would say it's probably not a good thing. It's
I'm with you there. No, that's a perfect backdrop to set up for the next one, because we'll have to watch that real closely. And I don't want to introduce new, but you have all these potential new IPOs coming out, right? SpaceX and these other private, and that's going to drive some really interesting dynamics potentially in the market going forward. That'll kind of cue us up for next time, but we'll cover whatever's going on. And your involvement and participation on the podcast has just been fantastic. Really appreciate it. And it's given me a lot to think about. And these are things that part of my process that I utilize every single day, all the time, with clients, with portfolios, just watching. It's one element. It's not the whole thing, but it's pretty important. So we're paying attention to that and trying to grow and safeguard people's capital. So that's what we're doing here. Really appreciate you being on, Miles. It's great.
Of course. Yeah, I always enjoy it. And just looking forward to being on next quarter when markets undoubtedly give us something more to talk about.
There's always something interesting to talk about, right? And if not, we'll go into process and what is working or what's trending. And so, again, appreciate it. I really appreciate folks who listen. I hope this has made sense to everyone. If you have questions, let me know. Also, please feel free to share this. I really appreciate you listening. Thanks again, Miles. Thanks for everyone for listening, and make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.